We are now on. So, guys, I believe that you have some questions for me. All right. I reviewed your PDF, the report that you already have. That I have a few remarks on that, but I think the most important thing is to address your questions first and foremost, because I believe that based on my answers, you will have some follow-up questions. The key here is to help you as much as possible. So I want to handle and to address all of your questions first, and then we'll get to my remarks. Okay? Yeah, no problem. Yep. Yep. Yeah. 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 I agree. Mm-hmm. Yep. Sure. Makes sense. Well, when it comes to the sustainable growth rate, uh, there are many ways we can address that point, but using the last 5 years, I believe you mentioned from 2020 to 2024, right? Yeah. So that can be possible, but knowing what was the recent past of the company, I have some caveats regarding that, and the reason is because well, you already saw the financial statement, so you are aware of this. Um, 2021, the last couple of months of 2021, and especially 2022 as a whole, was really a remarkable period for the company because of the large increase in prices of the paper and also the pulp as well. Let me just put in my laptop recharging because yeah, running out of battery. So, but the thing is that it was a very remarkable period, all right, and then on the back end of that particular period of 5 years, we start to see even a drop in prices over 2023, and then on 2024, we continue to see that downward trend in the market, followed up, and this is now important for 2025 because you already have access to 9 months worth of financial statements of 2025. You have seen also, I would say, a significant appreciation of the dollar relative to the euro. And this is important because, as you mentioned, and very well in the report, Navigator is heavily um, exposed to the exchange rate between the euro and the US dollar. And having a depreciation of the euro, the exports in euros will become more expensive to American consumers, right? For the ones that import the Navigator products, and you will have also to consider the fact that your revenue will be worth less when you convert it to euros. So you have the volume effect because you export less. The products are more expensive for them, and also you have the exchange rate effect because when you convert this back to euros, because we Navigator reports with euros, you have also this depreciation effect because of the exchange rate. So I would be very cautious in using the last few years, all right, as an exchange rate, as the compounding annual growth rate, because you have I think some one-off events that we may not have in the future for until, let's just say, 2030, you see. So especially because now we are in a period that interest rates are nowhere near the interest rates that we have at the beginning of this decade, especially in the post-COVID period. So, and they will know. I don't see how interest rates will go back to that level, which is basically near zero. So, because of that, the inflation levels will remain somewhat in control. All right, over this period, and so it's hard for me to see the level of prices in the paper and the pulp to go back to the levels that we have seen, especially in 2022. So I would use, I'm not going to say an average of those, but I'm going to use a little bit more of a conservative compounded growth rate than the one that you have seen throughout those 5 years. By the way, I need to make this disclosure. I'm a shareholder of Navigator. I follow the company rather closely. And so for me, this is my view of what I have seen because when the quarterly reports are released, I have a look at them. And based on where I see where the company is at the moment, and based on what I believe it will be in the coming years, I find it a bit hard to believe that the growth rate that we have seen over the last 5 years will repeat over the next five. And also keep in mind, as you also mentioned in the report, there are a few segments in the company that are growing very, very fast. You mentioned the tissue. Of course, the tissue, one of the reasons why is rising so fast is because it started from a very small base. It was nowhere near the focus of the company. The company was focused on the pulp and the UWF, the paper, and the tissue was some sort of a segment they started to bet rather recently, just a few years ago. And now you're starting to see the effects of that focus, of that investment, you see. So will it continue to grow at that rate? I think it's very unlikely, especially because you will not be able to saturate the market with this product. All right, there's a cap, there's a ceiling in terms of demand. Right, you cannot continue to grow indefinitely at that particular pace. And not only in terms of the tissue, but in terms of the packaging as well. The packaging is also a segment that they started to invest rather recently. It also been growing very fast, but at some point the growth will start to taper off. So you have to be very mindful that what happened in the past happened under specific set of circumstances, which, in my view, may not or are rather likely not to be repeated in the coming 5 years. You see, because of what we mentioned about exchange rates, about interest rates, about the geopolitical circumstances that we see. It's possible. This is my view. All right. The U.S. administration will only be there unless they amend the constitution. Will only be there for the next 3 years, And so I believe that, all right, when the next U.S. administration comes, it's possible that the influence of the tariffs that are currently in place and have been hampering the performance of Navigator in the U.S. probably may not be there. All right, and so you have to keep in mind this, because at the end of the day you are dealing with a market, and I'm focusing now only on the United States. You are dealing with a market which has a company as well. The I believe it's the Pope Resources, which is, I think, the biggest US player in this field. But they need to rely on imported product for them to keep up with their internal demand, domestic demand. So I don't see why, for example, even if that the U.S. administration changes to a democratic one, the tariffs will remain in there. I don't see, but you have to weigh in all these factors. But in my view, I don't see the compounding annual growth rate that we had over the last couple of years continuing. And as you can probably see, I noticed that you have in your report, there's a reference about the first half of this year for 2025. I think it's the net debt to EBITDA, if I'm not mistaken. You mentioned that it is at certain level. If you look at the report from for the third quarter, this ratio has deteriorated significantly because of a large drop in revenues, because of the tariffs, because of the fall of prices of pulp and paper. So you see, these things can change very rapidly, and the market is relatively volatile. The pulp and paper markets are relatively volatile. So I would keep that in mind. Are you taking notes? I suppose, right? Yeah. All right. But of course, if you have any counter arguments, please just tell me, and we'll discuss those. Of course. I think that the intention of your teacher, your professor, is a good one. I think it's a standard base for you two guys to work on, but uh, because you are doing the research and you have a bit of a more of an inside knowledge, of a more in-depth knowledge of the company that probably your professor has, because I don't know if he's involved in the research, if he knows the company well enough, but these are the factors that I would keep in mind. Yeah, of course. Yeah, yeah, highly unlikely. Highly unlikely. Yeah. But you have that kind of information. I would not lose too much time with the beta, because I believe at your university you may have access to a Bloomberg terminal, right? Well, I assume in many universities you have business schools, for example, you usually have access to a Bloomberg terminal in the library. Um, but even if you don't, it's not a problem. You can go online. There are many websites. For example, I don't want to advertise anything, but for example, Market Watch, it is a site that I use a lot, and they have usually some information on the beta of a particular company. You can use that if you want. Of course, you can use this as a ballpark of what of what it should be the beta, but then you make your own calculation and see if it's approximate. If it's too far off, you may be using some wrong information. But use this as a reference for when you do the calculation, because I believe in any case, you should do the calculation to show that you are able to do it. Just use this as a reference. All right. Absolutely. Makes sense. Makes absolute sense. I just want to be absolutely certain that you are not coming up with a value which is completely different from what the market perceives or what the market calculates. You see, it's very good that you stay relatively close to what is the usual number known publicly. All right. Mm-hmm. Yeah. Yeah. Mm-hmm. Yeah. Mm-hmm. The file that you sent me, it states 9%. Yeah, yeah, yeah. Mm. Um, it's a bit uh, it's a bit subjective when it comes to the sources of the data, but it's absolutely key that you use market values, not cost basis values. All right. So in that sense, what I think you should do, this is going to take some work, I think, especially if you don't have a Bloomberg terminal. But I think you can find this information online. It's not a problem. You can go to the financial statements of the company. All right. You are doing this calculation for a year end 2024, right? Right. So you go to the annual report, and you'll see what are the bonds that the company currently has outstanding. All right. And then once you have these, you go online, you search for the price that these bonds had, price relative to the par, all right? The price that these bonds had at year end 2024, all right? You can use these, or a bit more complex, but you can use the average value of these. But I'm not sure if you are able to find these values. Ideally, the best thing is that to use the average, but I think Navigator issued some bonds over the period of 2024. So to avoid overcomplicating, use just the value, the price, the market price of those bonds at the end of 2024. And you need to consider also because these bonds, the principal is only paid at maturity, so you need to keep in mind how much is the principal, all right, to use as a weight for the calculation. And then this is for the side of the debt. For the side of the equity, you just use the market price that was at the time of year end, and you need to use, as always, the stock, the amount of shares outstanding, which are part of the free flow. All right, I do I would not the part. I mean, not the part of the free flow, because, as you know, SMAPA has most of the shares of the company, but those should be counted as to the calculation of the market cap. All right, because what you really want to know is the market cap of the company for the calculation of the WACC. All right, so you count those, but you don't count those, for example, that the company Navigator Company has bought. I don't know if they have any. I can't remember if they have any own shares in their own balance sheet. But if they have, don't count those, because if they bought them back, they pay the investors who initially bought them. All right, so they paid back the investors, so they don't. They are no longer in circulation, so to speak. The investment was paid off, so don't count for those. Count only for the shares that are in the hands of investors, be it Samapa, which is the largest shareholder, institutional investors, retail, and others. All right, but you can see this in the annual report, how many shares they have outstanding, and then you subtract the ones that may be in the balance sheet. All right, and you multiply by the price. So and then you have your market cap, and that should be the weight that you should use to calculate the cost of equity. All right, the cost of equity, the actual rate. Uh, when I was doing the CFA, we usually use the CAPM to calculate it, and I would not overcomplicate in that regard. Use the CAPM to find the cost of equity, using the beta that you determine, as we mentioned before, and that's it. And you can assume as a risk-free rate, considering the company, which is a Portuguese company, I would assume the 10-year bond rate for the Portuguese government bond for the 10-year as a risk-free rate. And the market rate, the market rate could be for this case, for the market rate, you can use the average return that the stock market had over the year 2024 for the Portuguese stock index, for example. If you see that the number is very, very far off what you would expect, which should be, of course, higher than the cost of debt, you can use another market. You can use the stocks 50, which is the most important European stock index, something like this. You see. But I would start by trying the Portuguese stock index return for 2024. A third alternative, but I'm not sure if you can find this, is to use the MSCI World, or if there is an ETF focused on companies in the pulp and paper sector, if you can track the return of those for 2024, that can also be an option, right? As long as you can justify the use of a market value, a market return, it's okay. You mean the graphs on the left of the first few pages in your report, right? All right. I noticed that a few of those either are very small, some of those I think lack the legends. I may be wrong, but I don't know if you are using one legend for more than one graph, but I noticed that it was not that straightforward. Some members of the jury may pick up on that. Um, but let's see. I would like to see, and this is something that I notice here, for example, you have on page number 4 the total capacity, in which you have Navigator in first, Alter in second, NC from Spain in third, you see. I think, and it makes sense given the international exposure that Navigator has, and this is something that I also noticed in your report. You do not have any reference to probably the biggest players in the world in this field, which is the APP China, the biggest one in the world, which is part of an Indonesian conglomerate, right? Which is a um, Sinar Mas Group, I think. I think the name of the conglomerate is Sinar Mas Group, which is Indonesian. But they have a subsidiary which is the APP China, which is the largest producer of pulp paper in the world, and it would be interesting to to compare not only on these metrics but on others. For example, the economic performance. How does Navigator stack up against this company? And the biggest one in Brazil as well, because which is a very well-known international player, which is the Klabin in Brazil. Uh, I'm sure that in size they are a few times greater than Navigator in terms of size of the business. And so it would be interesting for you guys to compare not only against these players that you have, even if you have to eliminate a few of those, because I think a few of those are, yeah, in terms of size, they are, yeah, very tiny compared to Navigator. So I would compare against some of those that are smaller, which you have in here, but also against some of the biggest players in the world. This is something that caught my attention. For example, the next one on page number 4, I believe you are using the legend below the second graph to also explain the bar chart above, right? If I'm not mistaken, right? Yeah, I would. Uh, yeah, because you don't have any light green bars in the bar chart, so you may run the risk of not conveying the right message, because yeah, it I figured out after thinking about it for a while. Yeah, probably this is what they meant, but try to use for each graph one legend. I think it would be helpful to understand for the understanding of the reader, right? Um, Now, again, let's see. Market demand. Yeah, these. By the way, these projections for the European market demand. Where did you get these? No, sure. on at the end of page number 5, you have the European market demand in up to 2024 at the bottom, right at the bottom, the last graph at the bottom. And you have the projected market demand all the way until 2032. And I was asking, where did you get these projections? All right. Mm-hmm. Yeah. Yeah. Mm-hmm. No problem with that, but you need to disclose the source. Uh, yes, you can. But because even if you say at the end, all right. For example, let's just say at the end, you say company data, whatever. But the reader does not know which data was data that you got from whatever sources or you got from the company sources. You see, you can even use footnotes. I know this particular document was in Word before, and you convert it to PDF, I believe, because you have some numbers sometimes in between in between sentences, and this tells me this must be something like footnotes. All right, so you can use footnotes, not a problem, but you need to tell where to get this information. Each piece of information from each graph, it's absolutely key that you tell where to get these numbers from. Either Bloomberg, annual reports from Navigator, whatever, right? This is very important. That's why I was asking, where did you get these projections? Because making projections and putting them in here, I mean, what credibility they have? Did you come up with these numbers out of nowhere? Did you use company data? You see, so that you can convey about the reliability of those. All right. Um, Now, let's see what else. I think it's good. In terms of the graphs that you have here, I would like to see, but I know that you haven't finished this yet. Um, you haven't done a sensitivity analysis on the balance on the not on the balance sheet, but on the income statement. This would be very important. All right. Because I think you may have this in mind at some point to do this, but it's very important for you to know, especially in terms of leverage, the degree of operational leverage, the degree of financial leverage, all right? And you need to see, all right, for example, if you have revenue dropping by 1% or 2%, how much of the bottom line is affected by it, all right? How much of your operational profit is affected? This is important. Not only revenue, but 1% in variation or change in interest rates, for example, uh, 1% in the cost of goods sold, because at the end of the day, you are dealing with a product which is a commodity, and so your business is highly influenced by the market prices, and these are completely beyond the control of Navigator. Also, what is the impact of 1% change in your fixed costs, right? That's also important. And given the fact that you currently are dealing with a government in Portugal, which is somewhat corporate friendly, um, and there's a plan in place that they want to reduce the corporate rate tax progressively over time. I would also make a sensitivity analysis on 1% change in the tax rate. That would also be something to keep in mind. I would, this one, the tax rate, is probably the least important, but given the fact that this is something that will happen, all right, at least the government promised to do that over the next couple of years. This is something that I think it would be interesting also for you to see. Using, of course, your projected values for the next couple of years. Let's see what else. You're also going to do a scenario analysis. I saw somewhere you're going to do a scenario analysis, right? Yeah, evaluation. Do you already have some scenarios for this? Mm-hmm. No, it's okay. I just want to know if you already have in mind the scenarios that you are going to use. Yeah. Um, I'm sure you already dealt with something like this over your studies, but a scenario analysis is in many ways a stress testing, right? You create a specific set of conditions, extreme ones, and then you see how much of the performance of the company will deteriorate under that specific set of circumstances. You can say, for example, if the price of the commodities, uh, let's just say there is another inflation spike, which I think is unlikely, but given the interest rates that we have currently today, but let's just say that we have again an inflation spike. You will have a price increase in the prices, international prices of pulp and paper, but your costs will also increase. Let's just say by 10% as well, or something along those lines. And then you'll have also an increase in interest rates, because interest rates will have to come up to contain the inflation, and you can tell that the inflation is going to rise by the interest rates will have to rise by 200 or 300 basis points, and this will have an impact, of course, on your financial costs on the same scale. For example, you see one situation like this, or a situation in which, for example, you will have a new. You mentioned it's unlikely, and I agree, but you are probably dealing with some companies in this environment which may be subsidized by governments, especially the ones coming from China, and it's possible that you may have some sort of excess demand in the market, and as a result of that, yeah, prices just drop by a large amount, 10, 15%, or even 20%. And then what's going to happen, like yeah, because in those cases, because it's something very, very specific to a market, you may not expect that this will or this will spread to the rest of the market or the economy as deflation, you see. And so this can happen. The interest rates remain more or less the same, but your drop in revenue is significant, and then you have the same costs. What's going to happen? Um, it's also good because that you see, for example, um, Navigator is facing some capacity constraints. If you have been paying attention to the news over the last year or two about the company is now relocating some part of its production to Spain because they cannot increase their exploration of the forests in Portugal. They are finding very difficult to do this, and so they have to go. I read they are going to Spain to make up for this lack of capacity that they are allowed to have in Portugal, and so you can see, for example, the impact of yeah you are struggling to increase your capacity further in terms of the supply if you have a supply restriction in some way, right? And then what's going to happen if you don't have the raw materials? You cannot produce as much as you want or as much as you need to give to sell to your customers. For example, a change in regulation. This is something that, as you mentioned in your report, this area, this business is a bit vulnerable to new regulation, especially in the environmental front. Yeah, yeah. It depends on the scenarios you want to simulate. But for example, if you have yeah, like I said, if you have an inflation spike again, like you had in 2022, for example, uh, for whatever reason, you don't need to tell the specify very clearly what was the source of that spike of inflation, but you can say an inflation spike across the market. Do I'm using more than 6 words. I just want for you to have an idea of what I'm talking about. All right. You have, for example, um, it can happen that you have a summer season with a lot of fires, and you have a restriction of supply. Right. It can happen, especially in Portugal. This is something that happens every single summer. So no, no, not nothing specific. You can say something along the lines of a natural disaster that restricts supply. You can tell you don't need to say exactly the event, but you can say, all right, what is the sort of incident that this can be, right? An inflation spike, you can tell, for example, um, the impact of a massive increase in the price of international prices of pulp and paper, or for example, um, like I said, a new player coming into the market, a new large scale player coming into the market, which would restrict um, your ability to set prices at a given level. So you have to reduce the prices to keep up your market share, to keep your market share. Yeah, something like this. This helps. All right. I notice as well you have a grid here on page number 11. You have everything here in Portuguese, or many of these cells are filled up in Portuguese. So I would recommend that you change this to English. Yeah. Nah, it's okay. It's okay. No problem. Yeah. As long. Yeah. Tell me. Uh, it always comes down to what is the strategy of that player. You see, because this player, well, if it comes with a strategy of going for a low cost strategy with a low cost product, honestly, I don't think this new player will have any chances. No way, because uh, if it has this strategy, this is because probably his financial soundness is questionable, and so he will not be able to handle the fluctuations of the market prices of pulp and paper. So I think that's off the table. But if it's a big player and is heavily subsidized by a government, and is engaging in some shady practices which may not be that detectable, such as dumping. All right, this is of course illegal, but of course we all know what happens in with when governments get in the way and they heavily subsidize companies. This can happen, and if this happens, it puts a lot of pressure on the supply of the market, because yeah, if you have your market flooded with a product, you have no way to keep your prices as you want to keep it, in order to keep the business performance of your entity. So this is something that can always happen. It's unlikely. It's unlikely. There are far sexier businesses to go into, and with probably a less capital commitment up front, but still, we are talking in the realm of possibilities. You see here in the secondary method, the relative valuation, you talk about Suzano. Suzano is one of the biggest players in Brazil, and even so, you don't have any other reference to that in terms of the capacity, or the other graphs that you had a little bit up ahead. So yeah, and Suzano is a very big player. I would use one of those examples just as I mentioned with that big player from China, and the club in Brazil as well. That would be a good one. The ones that are very small, I would remove them because they are not significant. They are not significant, and you are competing in a segment in which, yeah, they may have some regional presence, but yeah, they are not your competition. You punch way above the weight of those small companies, so I would not even bother with those. They are not your peers. You see, you need to compare with your with your peers. I Yeah, tell me. APP China, and those that you have also in here, the Silvano, the Mondi. These are comparable, so I would keep those, yeah, as well. The UPM, the Arctic paper. I'm looking at page number 6 at this point, so I would keep these. Yeah, I would keep these, but those very small ones On page number 4, the SCA, the Sviloza from Bulgaria, the Olman, the Sodra from Sweden. These I would simply remove them. You don't need to have 20 companies to compare. You just have, for example, yeah, 8, 10 is enough. You want to convey a message. Adding those 5, 10 more will not bring any further value to what you want to convey. Yeah, yeah, yeah. I think it's much more useful if you find the same information but for those bigger players, because those are your actual competition, you see. Those are the ones who have the ability to sway the market, and Navigator, yeah, it's a player with some weight and some influence in the market, but does not have the same sway, and the Navigator may be forced to uh, go along what they are doing, and so because they don't Navigator does not have the size to dictate the terms of the market. So yeah, these are the ones that I would strongly suggest that you add to the graphs. There are a few. Now I'm looking here on the my macroeconomic backdrop. I believe you have more questions, but this is something that came to my mind. When you say, for example, the digital, what it is, the digital, the now the fact that many schools and all that are bringing back the textbooks and something like that. I saw this somewhere. Uh, I would be more careful with this because it's not going to be the same way as it was. I can't see this happening, this reverting back 100% to the way it was. In order for this to be a factor, it needs to be much more widespread, right? Because some of the countries that you mentioned, for example, I think Sweden is one of them. They have already their own producers, you see, and as you can imagine, especially when it comes to government action, you always have some sort of preference towards the internal players against the foreign ones. So I would keep in mind that this may be a factor, but it may not be that relevant. And another thing is that inflation, and sometimes I notice that you use some expressions that I would avoid. I know, for example, the cash cow, for sure. The cash cow is a very widely used term, but keep in mind that should be used quote unquote, not as in their strict sense. Uh, because yeah, I know it's the main money generator of cash flow from all the segments, but uh, either use quote unquote or avoid those expressions altogether. And the inflation and interest rates on the macroeconomic backdrop, this is important. Yeah, the capital cost is expensive, is a barrier to entry, no doubt. But here, for example, building a new greenfield pulp paper capacity has become prohibitively expensive. 1 billion for a modern mill. 1 billion is not that much. you with even private equity investors can easily get this sort of money for other projects, even more than this. I know that, like I said, pulp and paper is not the sexiest business segment in 2025, but still, 1 billion is not that much. Um, And yes, the FX dynamics, I think it's absolutely spot on. Uh, yeah, it's very very important. I would even emphasize the exchange rate works in two ways. Works on the volume, right? Because if the exchange rate works in your favor, you are able to sell more because your exports become cheaper to your counterparty. But then works also on the price because with this, when it comes back to the reconversion of the currency to your financial statements, you end up having more euros because the dollar has appreciated to the relative to the euro. So you have this double effect, which was also important to emphasize. Mm-hmm. Yeah, 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 yeah. Hmm. Yes. Um, I know that you converted this to PDF. I haven't seen the version in Word, but my first impression when I saw this is the pages are much too filled with stuff, with content. You see, you have no gaps between the chapters or the sections, and it's not as appealing as it could be for the reader to go through the report. I don't know if you have any page limit. I don't think you have, right? You don't. All right. So you have a limit of 10 pages, right? All right. Um, yeah, I know. I've also set on your side, so I know how difficult sometimes this is, because you want to make sure that you don't leave any stone unturned, and you want to mention everything you can. But it comes to a point in which it's too much. You have no gaps between the sessions, and you also have some graphs here, which I think you could gain some space by shifting towards the annexes, and you put the footnote to say that this is in annex 1, 2, 3, 4, 5, whatever. It's much better. It makes it cleaner, and it's easy. It becomes easier to read. You see. Um, I noticed that, for example, you say at the top, Navigator is recognized as one of the most efficient global producers of BEK pay. But, for example, yeah, most efficient global producers. But you can say this, all right, no problem. But sometimes it's important that you keep in mind that you are comparing against who. You see, it's important that, all right, even if you can say this at the top, but then these kind of things you should support this with data. All right, it's important that you solidify these statements with the data, and that's when you can make those comparisons, as I mentioned, with those big players that we spoke about. um, Now, let's see. Yeah, the legends of the graphs sometimes, yeah, they are missing, and this is something that's important in the annexes. Yeah, if you put this in the annexes, you have more space to put the legends, and so this would be nice to have. You will have the sensitivity analysis. I think this is one of the biggest assets that you will have in your report. Extremely important. I also notice as well here on the ESG component. I know that they are very good. They have a very high level of on the ESG indexes worldwide, which is good. One of the things that I don't like here, it's my opinion, all right? Take it at face value. But when you say here in the governance disclosure, for me, ESG, the most important aspect and the one that can be the most damaging to companies is the governance. The environmental, the social, all right, they have their importance, but the governance is for me the make or break of a company. And when you say here, the ownership structure balances strategic stability with market liquidity, all right? SMAPA retains a controlling 70% stake, ensuring long-term planning. For me, I don't necessarily agree with this. You have long-term planning, but something is missing. And what I mean is that when you have a major shareholder, right, you are basically in a situation in which this shareholder dictates the terms of the direction of the company. All right, you get the long-term stability, but keep in mind that you have board members which sit on the shareholder table on the board meetings of the shareholder and on the board meetings of the company itself. All right. And in this case, if you know about the structure that we are talking about, you have basically a family dictating the terms of this company. And if all the power that is clouding over a company is a family, sometimes you have the risk of having some conflicts of interest going on, and yeah, other issues that of course may happen, may not happen, but this is something that it's not the most appealing governance structure that you can have in a company. All right. If you see, for example, one of the biggest examples that I can give you is, for example, the fact that let's just say SMAPA decides that they want to take to the assembly, to the general assembly, the board, the shareholder meetings, a vote to distribute a dividend extra or reserves or anticipate some profits payments to shareholders. All right, because they have the majority, they can put this topic on the agenda of the next shareholders meeting, and because they have the majority of the votes, yeah, whatever they take to the table of the meeting, it's approved, right? So, and the other investors have no say whatsoever in whether they agree or they do not agree. They are a non-factor. And all right, so far the company has been doing very well. I like the management, no problem with that, but you don't know what the future holds. All right. And you have a family, it's a family running the business, pulling the strings of the business, because SMAPA has a 70% stake on Navigator. SMAPA is owned by 83% by Sodim, which is a family company of the family Queiroz Pereira, which is one of the most influential business families in the country. So you see what I mean, right? I have no doubt about this, the long-term planning, but it also requires some mentioning that this is a risk. This is a potential risk. You can tell this in the material ESG risks and their impact. Sure, sure. Yeah, I was saying this because this is where this topic came to mind. You see, so you can tell this in the material ESG risks, of course. You can say uh, fosters or yeah, but not ensure long-term planning. It's not guaranteed. All right, anything can happen. All right. It is a factor that fosters sound long-term planning. For example, something like this, it helps. It helps. It's something that is a can be an advantage. It has been an advantage. All right, but it's also a risk when you have a very restrict group of people dictating the terms of where a company should go. So far, it's been sugar and spice and all things nice, but yeah, things can revert at some point. Um, I'm seeing here, for example, the graphs that you have on the paper sales, pulp sales, tissue sales. For me, I would definitely put these on the annexes because they are taking too much space here on the actual page of the content on page 8. So and you don't have any margins. You are not working with any almost any margins on the top and the bottom. So it's good that you also leave some margin to give some clearance, to leave it less dense, the paper, you see. um let's see what else. Capex, yeah. Yes, yeah, you talked about the capex investment that they did on their Stubal infrastructure, which is good. Conservative balance sheet, not balance. This is bear case, all right. Building a resistant portfolio. Um, Now here, present value, enterprise value, number of stock, shares, risk-free rate. Yeah, you use the 10-year bond, German bond. You can use it. It's a good one. It's okay. Yeah, yeah, it's a good one. It's a good one. No problem. Yeah. Beta levered 105. Yeah, I think it makes sense. It could be. It could well be something around that. Country risk premium. Yes, correct. Cost of debt pre-tax. Yeah, maybe. Yeah, 788. Yeah, could be. But again, the cost of debt, you have this bond which expires on 2031. Um, why do you use only one bond? Why this bond? All right, it's cool. It's cool. No problem. No problem. Uh, I think it makes more sense to use the average cost of debt that they have. Um, or yeah, let's see. Probably the reason why he used this one was because the most recent bond that it was issued. Um, you can keep it. You can, yeah. Feel free to keep it. It also makes sense. It also makes sense. No problem. Yeah. Um, we are in a situation that probably the European Central Bank will not continue to lower interest rates, and yeah, the rating, the our rating, the government rating from Portugal may improve over time, but will not go into the double A's plus or triple A or anything like that. So the cost of debt, the premium, the risk premium will not change that significantly. I will keep it as it is. Yeah. Uh, this tax rate, this tax rate, I would keep in mind the projections with that reduction, progressive reduction of tax rates, the corporate tax rate that will occur if the government delivers on its promise. Yeah, I would consider that. Um, why do you use this target debt to capital? 25%. Is there any reason for this? Hmm. Yeah. No, I just wanted to know why this number. It's okay. It's okay. It's okay. For me, yeah, I don't think that's much of an issue. The balance sheet of Navigator is usually strong, so it's probably somewhere along those lines. Uh, but 25% it appears to me to be a bit low for the company. Um, I may be wrong, but yeah, it appears to be a bit low. And keep in mind that if you have too much capital and very little debt, your WACC will increase, right? So I know that debt always sounds bad, but in the context of a company, uh, all equity is not optimal for sure, even from a tax perspective. Yeah, the perpetual growth rate 1.5. Yeah, I can live with that. Yeah, yeah, I think it's yeah, it fits. Um, yeah, the stocks. Yeah, keep it this way. Keep the number of stocks they currently have. Sometimes they do share buybacks, but yeah, these are very random events. I would keep it as it is. Let's see, beta 105, equity risk premium 6%. You get this equity risk premium from Damodaran, right? That's what it says in here. Equities, the equity risk premium 6%. It says Damodaran estimate. No, it's okay. It's okay. It's fine. Because I mentioned before that you could use the CAPM, but if you already have this one, yeah, no problem. No, you can leave it. Commodity trap opportunity, trade deep discount. Deep discount, all right. Purely pulp prices, dividend yield, rewriting, growth face healthy net. That's a EBITDA. All right. This scenario analysis will be very important, and I really want to see that. The investment risk, market risks. I think this is pretty much bullseye. It's yeah, these are the key factors. For sure. Operational risks here in operational should be operational. There are a few things here in Portuguese as well, but yeah, you will change this against the dollar depreciation. All right, safety labor risks. raw materials. There was, let me see, Swedish competition. Right. Yeah. Um, there is a title somewhere which says um tissue and package as new grow drivers. I'm sure you wanted to say growth, so yeah, it's somewhere here. Well, it's in a title. You already found it? All right. Yeah, that's it. Um, yeah, that's no, it's okay. It's okay. Geopolitical instability, right? Cost spikes, bottlenecks. Here you see in these risks that you already see here, operational risk, political risk, you already have everything to do a scenario analysis. You the way you describe the operational risks and the political risks, you already have here some assumptions that you can use to do a scenario analysis. This is something that you can use, put one place to the other, because when you say, oh, a 4% reduction in this, a 5% increase in this, these are already the components that you need to perform a scenario analysis. A 2% increase in labor costs and all that, it's good. This is something that you can use. Um, market risks, investment risks. All right. Um, now, political risks, market risks. Yeah. Um, sophistication branded papers on the superior margins. All right. In terms of here the market risk, premium product differentiation, branded papers allows the company to maintain margins superior to those of generic commodities. Now, it's very important that when you see when you make a comparison with the biggest players, you should confirm if this still remains the same. All right, if these margins remain superior to those of generic commodities, but also to the relative to the value proposition that these companies also provide to the market. All right, it's good to compare more than the numbers themselves, because the numbers themselves may be very far apart. We are talking of companies of different sizes, but about the margins. All right, the gross margin, the operational margin, and the net margin. All right. These are very, very important aspects that you need to cover. Tissue acquisition in Spain and UK, yes, sure. And there will probably be more acquisitions in the pipeline, but yeah, they don't want to tell anything in advance. Yeah, return on invested capital. Yeah. All right. I think this is pretty much it, but again, because now I'm seeing here the cash generation sustains shareholder returns and the lending margins and all that. So, uh, honestly, I don't see the at least for the next couple of quarters the the margins that they used to have in terms of return or return on invested capital, and even the margins that they have for at least for the next couple of quarters, given the situation that we are dealing with at the moment with the tariffs and with a bit of a compressed prices in the international markets of pulp and paper, I don't see there being able to do to achieve these kind of margins. All right. So this is something that you also need to keep in mind, because this is the current situation and we don't know for how long this will take. All right. The Navigator took a big hit this quarter. Altri, for example, which is one of his peers, I think he took an even bigger hit. I think he had a reduction in profits in around 70% or 80%, which is enormous reduction of profit. So we don't know for how long this will continue. And Altri is also a company which is very exposed to the United States. So the markets they both of them operate are relatively similar. So keep that in mind. All right. This can continue for quite some time. And I think this is pretty much it for now. Yeah, I think this is pretty much it. You guys have any more questions? Something that yeah. Yeah. Um, you already have the financial statements of the previous years. So you have also as well, because you will be able to determine the compounding growth rate. Always start by, because I think you will have to do the projections for the three financial statements, right? The income statement, balance sheet, and the cash flow statement, right? Good. So the first one that you all always must start is the income statement. All right. And when you do the income statement, you use mostly the projections that you have for the growth of the business. All right. You have your compounding annual growth rate, and you start by the revenue, and then you need to form your assumptions not only for the revenue, for the costs. You can assume the rate of inflation for those. I mean for the fixed costs. All right, fixed costs, because the cost of goods sold, which is mostly the raw materials, I would assume it will grow in tandem with the revenue. All right. So I can't recall how much is for example, the gross profit margin of the past few years, but yeah, that would be good. That's cool. Take your time. Gross profit margin. The margin, the gross profit divided by revenue. The gross profit is the difference between the revenue and the cost of goods sold. 7 point. No. The margin, the percentage. The percentage. It's okay. It's okay. No, that's not a problem. But keep in mind that um, you are working with I believe four different segments, which is the paper, the unwooded coated paper. All right. You are working with the pulp. You are working with the tissue, and you are working with the packaging. All right. It's good that you have a look at the financial statement for 2024, and you see how much is the weight of each of these components of the revenue. right? And how much is the margin of each of these, right? And then, based on your projections for the growth in the paper, which probably is already leveling off, but the growth that you have for the tissue, the growth that you have for the packaging, the pulp should be already more or less stagnant, but you have some projections for the growth of each of these four segments, right? And you have the margins. So you can assume that, for example, for the pulp and paper, for the pulp and the paper, yes, the margins probably will remain mostly the same, if not a little bit more compressed. All right, probably. This is something that I would assume. Without looking more in depth, I would assume this because it's already a very mature product. The margins will be relatively constant or probably slightly reduced over the years. Now, with the tissue and the packaging, the growth is big at this point. For sure, it cannot continue to grow at this rate forever. It may continue to grow like this for a few more years, but eventually it will start to taper off. And the margins, I don't know how much they are relative to the paper and the pulp, but if they are too far off, and I mean by this too superior, because there's a reason why the company invested in this segment, probably because the margins that they can command are higher. Otherwise, they would not go into a segment that would give us a lesser margin than what they already have, correct? So in this case, they may continue to have these margins, these larger margins, but at some point they will start probably to taper off as well, because it's normal. You cannot continue to have margins like this in a product like this forever, right? It's not a technological product in which you are continuously improving with new technological advancements and all that. So you can assume that at some point the margin will also start to taper off. And with this information, you start to estimate the revenue for the next couple of years. This is your main point, and everything derives from the revenue, because then you have the costs of goods sold is already accounted for in the gross profit margin when you calculate the gross profit. So you can keep the numbers, you can make the numbers for the cost of goods sold in order to give the margins that you believe will be the case. All right, and with this you have the cost of goods sold addressed. With the fixed costs, with the salaries, the infrastructure, the maintenance and all that kind of operational costs that you have, not the capex. The capex is for the cash flow statement, but for the fixed costs, you can assume the rate of inflation. All right, that's the standard approach, right? You can probably even assume that the rate of inflation will increase. You can put 0.1 or 0.2 above your expected rate of inflation, so that the workers continue to get some purchasing power gains, because Navigator is a quite generous employer in that regard. So this is something that you can always consider. For the financial costs, which is the next metric, because by this you already taken care of the operational profit. All right, for the financial side, you can just assume the cost of debt that you have. All right, for the financial costs, based of course on the amount of debt that you will have over those years. So you have the debt, the amount of debt that you have, you apply the cost of debt, you have the costs. Don't worry about the financial revenues that they have, interest and that kind of stuff, because that doesn't really matter much. It's not significant. And then for the tax, you can assume what we just mentioned. You assume the current for now, but then over the years you can assume, like for example, a 1% reduction in the tax rate, given of course what was promised that it will happen. And then once you have the income statement in place, all right, then you can go to the balance sheet and to the cash flow statement. Now, I don't want to make this too complicated, but you know that the balance sheet, of course, they usually say it's a snapshot, is a picture of where the company stands at a given moment in time, right? And when it comes to the current assets and liabilities, these are nothing more, and this is extremely important, and sometimes people don't realize this. The current assets and liabilities are nothing more that the temporal, it's a reflection of the temporal differences between what happens in the income statement and what happens with the cash flow statement. All right, because if you everything that you sell, you are paid on the spot, and everything that you buy to the suppliers is paid on the spot, the balance sheet, the current assets of the and the current liabilities of the balance sheet do not change. No, don't change. The receivables and the payables don't change. They remain the same. All right. So in this case, it comes into play your calculations for the balance sheet in terms activity metrics. The days of receivables, the days of payables, the days of inventory, and you can see how these metrics have performed over time, over the past few years, and you can assume that these will more or less remain the same. If the company has taken, let's just say, 60 days to receive its receivables for the last couple of years, all right, you can assume that this will continue, because a company must have some sort of policy that, all right, customers must pay at this time, always, and this is how much the receivables stay in the books. There must be some people not paying. You can continue to assume that the percentage of customers that don't pay remain the same. You do the same for the payables, and you do the same for the inventory. All right, this is something that you can do. Now, and the cash is something that you have to deal later, but this is what you do for the current assets and liabilities. All right. For the long-term debt and the equity, you have to assume what's going to happen for the target debt to capital ratio. All right, debt to equity. It's easier this way. Debt to equity, because if you think that the company has a specific target, and at this point, what is the gap between the current state and the target state in terms of debt? And so you will assume that the company will converge over time towards that target, and the amount of debt will be always long-term debt issued, and so you can assume that they will converge over time towards that target, and it will remain there. It does not go to the target in one goal in 1 year, but it will go progressively over time. For the equity, same thing. Of course, the equity does not change except for the profits that are retained, the retained earnings, and so you can adjust your expectations for the retained earnings accordingly to the target. Capital does not change. They will not issue more shares for sure. If they do something, they will reduce the capital by buy back shares and eliminate them. They already did this a couple times, but you can just assume that this will remain the same. Now, for the fixed assets, this is something that you have to see in the annual report and see, all right, what are their projections in terms of growth of the business. If they have, for example, in the past few years, you look at the fixed assets, you know their depreciation rates of their machinery. All right. There's a section in the annual report in which you can see what is the useful life of the equipment. All right. And so you assume that the equipment in place will have to be replaced at some point, and at this point you buy another one, another piece of machinery, and you know that you will have to depreciate it over these years, right? And this depreciation must be addressed in the balance sheet, in the income statement. All right. Are you bearing with me? Are you keeping up with me? Yeah. So, and then, of course, you assume this with the growth of the company, and all these investments in fixed assets that they do, you will have in parallel to reflect this on the cash flow statement, on the activity cash flows of the investing activities. All right. In the capex, you don't need to assume any changes in the receipts of the investing activities, the interests, the dividends from investments. Forget about that. That is not really important. You can assume that they will remain exactly the same as in the previous years. The important thing is the capex. All right. All right. So, and we already dealt with everything in the balance sheet. Of course, you may have to make some adjustments to make sure that the balance sheet remain balanced. All right, in terms of assets on one side and capital and liabilities on another. But then on the cash flow statement, the percentage of sales that you have that are not receivables, that you receive on the spot, the percentage that you have seen happening over the past couple of years, you can assume that it will continue to happen at this time. So you reflect this in the cash received from the sales. All right. The same thing for the payments to the suppliers. How much did the inventory it takes for the inventory to be paid? How much inventory is paid on the spot? How much is paid later? You assume that the same percentage which is paid on the spot, you put in the payments to suppliers in the cash flow statement. Same for the salaries. They are always paid in cash when they are due, so always reflect that. The tax is an interesting one. You'll have because you have a certain amount of tax every year that you have to pay, which is in the income statement. All right. Then you have to see in the past few years in the balance sheet how much is the deferrals and the accruals of tax that are in the balance sheet. All right, and you can assume that they are the same for the future, right? And then you'll be able to determine how much tax is paid on the spot for that particular year. This is what you put in on the cash flow statement. So we already addressed the operating activities of the cash flow statement, the investment activities, now the financing activities. Financing activities, you can assume that, all right, in dividends, you can assume they pay the same. They are, for the most part, they are pretty stable in terms of the payment of the dividends. In terms of the interest, you know based on the debt that they have, how much they have to pay in interest, and they are paying on the spot. They don't leave payments of interest for later, so everything they need to pay, they pay on that particular date, on that particular year. And of course, if you issue more debt or you pay fully some bond which will mature in the meantime in the future, you stop paying those interests and you don't reflect that on the cash flow statement on the financing activities. And then at the end, you reach the cash, and then that cash must match with the cash that you have on the balance sheet. And of course, then, like I said, you must be able to balance the balance sheet to make sure it's consistent in terms of one side and the other side. Is this clear? I know this was a bit too extensive, but you wanted the full picture. Yeah, this is by the book. This is how you do the projections. All right. If you ever do the if you ever do the CFA, you will be able to understand this from one end to another. Yeah. All right. Yeah. Absolutely, guys. Just let me know, of course, when you want to have the other section next week. Of course, for me, it has to be on the weekends in the afternoons, but just let me know with some time in advance, and we'll figure it out. All right? Of course, it's indifferent. It's indifferent. Yeah, no problem. That's not a problem. As long as you are all present, for me, it's good. Yeah. Never mind. It's already almost evening here, so that's okay. It's fine. Fine for me. It's okay. As long just send me an email and yeah, we'll figure that out. No problem. That's all. Yeah. Absolutely. Absolutely, guys. Okay, guys. Wish you the best and have a good week. Thanks. Bye bye. Bye.